So let's do a little bit of a recap. Why financial intermediary is special? There are a lot of reasons that we have to choose from.
Maturity, intermediation,
information costs, they reduce information costs. What else? Another type of cost? Transaction costs.
They reduce liquidity and price risk.
Yes, reduce liquidity and price risk, yes.
credit allocation, you said
Credit
that.
allocation, yes. Transfer of intergenerational wealth, yes. All right, so good. So those are sufficient. I know you're listening. All right? Or you may be looking at the slide. No, I didn't post them. So I took a picture. All right. Okay, so remember we said that financial intermediaries are the most heavily regulated businesses, right? Why did we say that they are the most heavily regulated businesses?
Because they hold a large amount of funds.
Because they hold a large amount of funds for a large amount of people. And if they are not regulated, what's the risk? Because the entire financial system is functioning. All right? So there is a slew of regulation out there for all financial intermediaries. For those of you who just completed elements of banking and finance, you know that there's regulation for commercial banks, and those are regulated by what? Central banks? Yeah? What about investment companies? Who regulates those? In Antigua and Barbuda, who regulates broker dealers, insurance companies, and so on? FSR, Financial Services Regulatory Commission. Right? And in the United States, you remember? In the United States, who's the regulator for investment banks and so on? Somebody study. What does SEC stand for?
SEC,
SEC.
The Security Exchange Commission.
What about in the UK? Trying to see if they remember from one semester to another. It's all right. It's okay. Right. So there are different types of regulation. You have safety and soundness regulation. Safety and soundness regulation. Generally, what would be some of the safety and soundness? Well, what do you use for safety and soundness? Regulate safety and soundness. Anybody? Too long ago for some of you. Safety and soundness, we use things like capital adequacy. All right, capital adequacy ratios, reserves, yes, okay. Monetary policy regulation. Central bank, all right. Credit allocation. All right. Consumer protection regulation. The SEC in the US tends to have that, the FSRC. Even the central bank has some consumer protection regulation as well, because that capital adequacy, making sure that you don't lose your money because a bank goes under, right? Investor protection, fiduciary responsibility regulations that investment banks have to adhere to. And there's entry and charter regulation. What this is the licensing or the chartering of banks. When you're setting up a bank, you have to get a license. You can only get a license if you meet certain requirements, right? Okay. It's raining, so we can stay till 2:30. All right. Now, financial intermediaries, you have depository institutions, you have non-depository institutions, right? On the depository institutions, we would have named some of them earlier. the commercial banks, that's the largest group of depository institutions, both by the amount of assets they have. They also accept deposits and they make loans, right? And you have savings institutions, they take deposits, but they really give mostly mortgage loans. Then you have credit unions, offer mainly consumer loans, financed by member deposits, but I think now in Antigua, the credit unions are also doing mortgages. Maybe small mortgages, right? And depository institutions, they are a little different in, their difference is really in how their balance sheet looks. And when we in tutorial, we will have a look at balance sheets of the various institutions, go to the balance sheet, see what makes them different, see how, what are the assets, what are the liabilities, the differences in assets and liabilities in those, right? And so, this is where you can find that, but we will do some of that in tutorial. All right? For deposit institutions, their assets are their loans, investment securities, and other assets, whereas their liabilities are their deposits, like that money markets, mutual funds, other deposits. All right? So we'll look at all of that. We will examine some balance sheets of deposit institutions. All right? Then you have the balance sheet, your assets, your liabilities, and your shareholders' equity. So you have stock and your paid-in capital. So your preferred stock, paid-in capital. Not all financial institutions have preferred stock, so you may just see on the balance sheet the paid-in capital or the equity. Then they engage, commercial banks or deposit institutions engage in off-balance, what we call off-balance sheet activities. For example, created by what you call contingent events. So contingent events meaning you are engaging in forwards and futures contracts, and so you create a contingent liability. Other contingent events, something like, we call them loan commitments, or I will go into that a little more. Then you have guarantees, like letters of credit, and then your derivative, any derivative trading, all right, to protect your portfolio. So we will look at those. Then you have your non-depository financial institutions. Everything else falls under that category. So the finance companies, so those are the ones that give loans. They give loans to businesses. And, well, what are the finance companies here?
Finance.
After finance.
Okay, of course, ready cash, I suppose.
Course ready cash, FDC, Finance and Development Company. And then you have dealerships that do their own financing. They are not full-fledged finance companies, but they can do their own financing. John. Close to see. Sure, that's not the,
I think it was the media.
oh, John said it was finance. Oh no, that's
also
a
different.
business.
Oh,
You have securities firms, investment banks, mutual funds, hedge fund companies, insurance companies. So those are the non-depository institutions. right?
Okay.
So that brings me to the end of what I need to say today. I will post the slides, but try to get the book so that you can read. There's a lot more detail in the text that you need to read. And if you can get the text between now and Friday for those of you in 2005, that would be good because we'll use that in tutorials. And then 3076, you still have a little time. Tuesday. All right. Next week in tutorial. Next week in class, we'll do a short quiz just on what we did today. All right. It's a short quiz. Yeah. Keeps you sharp.
For Grace? For Keats? Short. How much you want them?
Okay. All right, so